Let's check out a couple of interesting growth and income stocks now with our growth and income stock strategist, Todd Bunton. And one of them on your list is Qualcomm.
Yeah, technology stock. People are probably familiar with the name.
Yeah.
It's an interesting play here. The company developed CDMA technology, and 3G and 4G networks are based on that technology. So the company basically collects royalties from everybody that uses it, including smartphones and tablet makers.
Great position to be in.
Absolutely. With the growing smartphone market, analysts expect about 15%, at least 15% growth in smartphones over the next 5 years. So that means a lot of revenue for Qualcomm. And if you look, the company has met or beat the Zacks consensus estimate on earnings in each of the last 4 quarters. So solid earnings momentum going on here. A company has very solid profit margins. Of course, it collects that royalty in revenue, but the operating expenses aren't that intensive. So a lot of money falls to the bottom line and a lot of cash, which I'll get to in a second. But analysts have revised their estimates higher after the company's last earnings beat, sent it to a Zacks rank of 2, which is a buy rating. So very solid earnings momentum, which I talked about. And if you look at consensus estimates, analysts expect about 23% earnings per share growth this year, 11% growth next year. So obviously good growth story here. There's no debating that. But a very good income story too. They pay a dividend that yields 2.1%. But if you look, the company's payout ratio is just 31%. And if you look, they have over $30 billion in cash and securities and no debt. So I'd expect that dividend to continue increasing in the future. And if you take a look over the last 10 years, the company has increased its dividend at a 27% compound annual growth rate, which is absolutely phenomenal. And I would expect very solid dividend increases going forward, like I said, with a very solid balance sheet, relatively low payout ratio, and strong free cash flow growth every year. This one is a very good income candidate. And also the company recently announced a $5 billion stock buyback program. The company's bought back 4.5 billion shares year to date. So very shareholder-friendly company. Like I said, they have an excellent business model with very wide profit margins, very strong free cash flow, and they've been returning that to shareholders. So there's a lot to like about this, and if you take a look at the valuation, that's pretty reasonable too. They trade at less than 15 times forward earnings. Their 10-year median is at 22 times, so it's a significant discount to that. So there's some value to go along here. There's a lot to like about Qualcomm.
Proof that if you're going to be involved with royalties, you might as well be on the collecting side.
That's absolutely right. That's where you want to be.
And in case you're thinking of someplace to go for lunch, Cracker Barrel.
Cracker Barrel. I've talked about this company before. They operate 624 company-owned stores, all in the U.S., in 42 states. But the company continues to impress. They've delivered 9 consecutive positive earnings surprises. They've had 7 straight quarters of positive same-store sales growth. And through prudent expense management, they've been able to grow their earnings at a double-digit clip over the last several quarters. Analysts expect that growth to continue. But if you take a look, analysts have steadily revised their estimates over the last several months. You can take a look at the price and consensus chart here. Just a nice steady upward trend in consensus estimates for both this year and next. Sent it to a Zacks rank of 2, which is a buy rating. And based on consensus estimates, analysts expect 16% earnings per share growth this year, 9% growth next year. So very solid growth for a somewhat mature company in a mature market. They're located only here in the U.S. But again, that's come through low single-digit same-store sales growth, but really prudent expense management. So solid growth story here, I'd say. Analysts expect, like I said, solid growth over the next couple of years. They expect that same-store sales growth momentum to continue into fiscal 2014. And the very good income story. They pay a dividend that yields 2.9%. And they've more than tripled their dividend since 2011. So very shareholder-friendly company here, and all that at a fairly reasonable price. They trade about 17.5 times forward earnings. That's above their historical median. But given a lot of the positive momentum here, I'd say that premium is justified. And if you take a look, the industry median is right around 20 times. So they are actually a discount to their peers. So there's a lot to like about Cracker Barrel as well.
Wonder if it's the food or those retro toys and candy that draws people in.
Could be both. They've been seeing both. Yeah, they actually do split up their sale or their same store sales into the restaurant side and the retail side. Those both been growing. So a lot of foot traffic coming in.
Do you own either one of these?
I do not.
All right, check out other stock picks and stock picking strategies on our website, Zacks.com. If you're not there watching this video, get on over, and get on over often because they change often. With Todd, I'm Terry Ruffalo.